There's a 600 trillion market that few understand, one that nearly destroyed the global economy in 2008. Today, it's 10 times larger. In 2003, Warren Buffett called derivatives financial weapons of mass destruction. He was right. They caused the collapse of Lehman Brothers, the bailout of AIG, and the near-total failure of the global banking system. The response to that disaster wasn't to eliminate derivatives or even contain them, it was to expand them. Now this market is worth more than 6 times the size of the entire global economy, and when it explodes, not if, but when, there won't be enough money on Earth to bail it out. Most people have never even heard of derivatives. Even professional investors struggle to explain them. Yet these complex financial contracts underpin every major bank, pension fund, insurance company, and government bond market on the planet. They were designed to reduce risk, to hedge against losses. In reality, they multiply it. Leverage stacked upon leverage, bets built on top of bets until no one truly knows who owes what to whom. And that's how systems collapse. In 2008, it took $29 trillion in global bailouts and guarantees to stop a complete financial meltdown. Back then, the derivatives market was $60 trillion. Today, it's $600 trillion. When this bomb detonates, its shockwave will be global, instant, and unstoppable. Let me show you why the next financial crisis won't be like 2008. It will be worse. To understand why derivatives are so dangerous, you have to start with what they actually are. A derivative is a financial contract whose value is derived from something else, an underlying asset. That sounds simple until you realize the asset can be almost anything. A stock, a bond, a commodity, an interest rate, a currency exchange rate, even the weather, or the chance that a company defaults on its debt. You don't need to own the asset to make the bet. You're just wagering on its direction. It's like buying insurance on your neighbor's house and collecting if it burns down. That's a derivative. The most common types are futures, options, swaps, and forwards. A futures contract lets you bet on the price of oil, gold, or wheat without owning a single barrel or bushel. An option gives you the right, but not the obligation, to buy or sell an asset at a set price. A swap allows two parties to exchange cash flows, like swapping fixed interest payments for variable ones. And forwards are customized agreements between two parties to trade assets in the future at a predetermined price. Each can serve a real purpose. A farmer might lock in wheat prices before harvest. An airline might hedge against rising fuel costs. A corporation with global debt might use swaps to manage currency risk. But that's not who dominates this market. It's dominated by banks, placing leveraged bets on interest rates, currencies, and credit risk with borrowed money. Here's where danger enters. The notional value of a derivative is the full value of the asset it references, but the real money at risk is much smaller. If a bank enters a $100 million interest rate swap, it might only post $1 million in collateral. That's 100 to 1 leverage. A 1% move against the bank wipes out its collateral. A 2% move means it owes money it doesn't have. Multiply that by thousands of contracts across dozens of banks, and a small market move can trigger a global chain reaction. The real issue is complexity. Modern derivatives are so intricate that even their creators can predict how they'll behave under stress. Credit default swaps, the infamous instruments of 2008, were meant to insure against bond defaults. Instead, they became side bets for investors who didn't even own the bonds. AIG sold hundreds of billions in these swaps without enough capital to pay out when mortgages collapsed. When the housing market crashed, AIG owed more than it owned. The US government had to inject $180 billion to stop its failure and save every major bank connected to it. But derivatives carry a hidden danger: counterparty risk. If Bank A owes Bank B money on a derivative and fails, Bank B doesn't get paid. Then Bank B can't pay Bank C and Bank C can't pay Bank D. Failure cascades through the system in hours. That's exactly what happened when Lehman Brothers collapsed in 2008. Lehman held $35 trillion in derivative exposure when it went bankrupt. Every institution tied to Lehman instantly faced massive, unexpected losses. Some couldn't survive. Others froze trading altogether, destroying trust and paralyzing global credit markets. AIG's downfall revealed something even darker: how a single type of derivative could destroy a trillion-dollar firm. Its financial division sold $500 billion in credit default swaps, insuring banks against mortgage losses it could not possibly cover. When housing prices fell, AIG owed tens of billions overnight. Downgrades triggered collateral demands it couldn't meet. The Fed's $85 billion loan only delayed collapse. By March 2009, the bailout had ballooned to $180 billion, the largest in history. But the AIG rescue wasn't really for AIG. It was a stealth bailout for the banks that had bought its derivatives. Goldman Sachs received $12.9 billion. Merrill Lynch got $6.8 billion. Bank of America, Deutsche Bank, and many others collected billions more. The losses didn't vanish. They were transferred to taxpayers. The institutions that created the risk got saved because letting them fail would have destroyed the system. The total cost of saving that system was staggering. The U.S. committed $700 billion through TARP. The Federal Reserve injected $4 trillion via quantitative easing. Governments and central banks worldwide poured in another $25 trillion in loans, guarantees and rescues. And yet, nothing fundamental changed. Instead of shrinking, the derivatives market exploded from $60 trillion then to over $600 trillion today, a market so large, so opaque and so leveraged that when it breaks again, no one will be big enough to save it. Add it all up, and the total commitment reached nearly $29 trillion, almost twice the size of the U.S. economy at that time. All of it was spent to prevent the complete collapse of a $60 trillion derivatives market. The system was saved, but barely. And the lesson the world failed to learn was that derivatives had become too vast, too complex, and too dangerous for anyone to control. The Dodd-Frank Act, passed in 2010, was meant to reform derivatives trading. It required standardized contracts to pass through central clearinghouses, which were supposed to reduce counterparty risk by guaranteeing both sides of a trade. It added new reporting rules so regulators could see who held what. But it didn't limit the size of the market. It didn't ban the most dangerous instruments. And it didn't fix the core problem. Banks were still making highly leveraged bets with depositor money and taxpayer backstops. Within just a few years, lobbying pressure had weakened even these modest reforms. The derivatives market resumed its climb. By 2015, it exceeded $600 trillion. The same market that stood at $60 trillion in 2008 had now grown tenfold, a market 10 times larger than the crisis that nearly destroyed the global economy. To grasp that scale, consider this. Global GDP is around $100 trillion. The derivatives market is roughly 6 times larger than the entire world economy. If just 5% of those contracts fail, that's $30 trillion in losses, triple the total cost of the 2008 bailouts. And there's no mechanism, no pile of cash, and no policy tool that could absorb that kind of loss without collapsing the global financial system. What makes it even more dangerous is its composition. The largest slice, more than $500 trillion, is made up of interest rate derivatives. These are bets on the direction and volatility of interest rates. Banks use them to hedge exposure, but also to speculate. When rates are stable, they look safe. But when rates move sharply, risk explodes. The Federal Reserve raised interest rates from near zero in 2021 to over 5% by 2023, the fastest hiking cycle in 40 years. Each increase created winners and losers, and the losers are sitting on hidden losses buried inside balance sheets, masked by accounting rules that let banks avoid marking these positions to market. The second largest category is credit derivatives, about $50 trillion in notional value. These include credit default swaps, the same weapons that wrecked AIG. After 2008, regulators vowed to reform this market. They didn't. Banks and hedge funds still use CDS contracts to bet on corporate and sovereign defaults. The difference now is scale. Corporate debt has exploded, from $2 trillion to over $10 trillion in the US alone since 2018. Much of it was issued when interest rates were near zero. As that debt rolls over at higher rates, defaults will rise. When they do, the credit default swaps written against them will trigger huge payouts. If enough companies default at once, the sellers of credit protection will face losses they can't survive. That's the AIG scenario, all over again. Except this time there is no Federal Reserve ready to print another $180 billion to rescue traders. Currency derivatives add another $100 trillion in exposure, and they re-vulnerable to exchange rate shocks. The US dollar has been the world's reserve currency for 8 decades, but that dominance is slipping. China, Russia, and India are trading more in their own currencies. Saudi Arabia now accepts yuan for oil. If the dollar weakens or loses reserve status, those currency derivatives will convulse. Banks that bet on dollar stability could find themselves on the wrong side of trillion-dollar positions. The unwinding would ripple through every market: stocks, bonds, commodities, and trade itself. The most insidious feature of modern derivatives, however, is their complexity. After 2008, banks didn't simplify their portfolios, they made them more complex. Now, you can buy options on credit default swaps, or swaps based on indexes of other swaps. Derivatives built on derivatives. This nesting creates exponential leverage, where a small move in the underlying asset triggers massive swings at the top of the pyramid. Even the traders who create them can't model their behavior under stress. Their algorithms assume normal conditions, steady liquidity, and reliable counterparties, but in a crisis, none of those assumptions hold. Markets freeze, prices gap, counterparties fail, the models collapse, and losses spiral far beyond what risk managers ever imagined. The concentration of risk makes this even more fragile. In the US, 4 banks control about 90% of all derivative exposure: JPMorgan Chase, Citibank, Bank of America, and Goldman Sachs. JPMorgan alone holds over $54 trillion in notional exposure, about 180 times its total capital. That means one miscalculation could wipe it out. This concentration destroys diversification. All 4 banks are making similar bets, driven by the same market signals and incentives. When they move together, a single shock becomes a systemic failure. That's not risk management, that's fragility disguised as sophistication. Together, these 4 banks hold around $186 trillion in derivatives, nearly double the size of the global economy. If even one of them gets it wrong, the losses could exceed their capital many times over, rendering them instantly insolvent. Their defense is always the same. They're sophisticated, backed by advanced risk systems, thousands of analysts, and regulatory oversight. But history shows sophistication doesn't prevent disaster, it often enables it. In 1998, Long-Term Capital Management, a hedge fund with 2 Nobel Prize winners and the best quants in finance, collapsed after losing $4.6 billion in 4 months. Its derivative exposure, $1.25 trillion, was a fraction of what today's megabanks hold. The Fed had to coordinate a $3.6 billion rescue to prevent systemic collapse. Now imagine that same web multiplied 100-fold, each major bank hedging with the others. JPMorgan with Citibank, Citibank with Bank of America with Goldman Sachs, and Goldman back with JPMorgan. On paper, it looks like protection. In reality, it is a circular dependency, a closed loop of risk where one failure instantly becomes everyone's eyes problem. If one bank fails, the shock spreads. Other banks suddenly face losses they thought were hedged. This is what happened in 2008. A few failures became a global crisis. Banks were all connected through derivatives. When one fell, they all teetered. Every bank had exposure to every other bank, through contracts, bets, and derivatives. When one institution collapsed, the system wobbled. The collapse of Lehman Brothers wasn't just a single failure, it triggered a chain reaction across the globe. After the crisis, regulators acted. Central clearing houses were created. Their purpose was simple: stand between buyers and sellers, guarantee both sides of each trade, prevent contagion from spreading. On paper, it looked like a solution. In reality, it covered only standardized derivatives, those traded on exchanges. The vast majority of derivatives, however, are over-the-counter, custom contracts negotiated directly between banks. These bilateral agreements carry the same risks from 2008. If Bank A collapses, Bank B faces losses. No clearinghouse steps in. The reforms look good on paper, but the market structure hasn't fundamentally changed. Even cleared derivatives are risky. Clearinghouses themselves have become too big to fail. If a major clearinghouse suffers losses beyond its default fund, it could collapse, taking all its members with it. During crises, clearinghouses can tear up contracts or allocate losses to surviving members. Even careful banks could face massive unexpected losses. Risk is mutualized. Prudent banks end up subsidizing reckless ones. For 15 years, the derivatives market has survived. This created a dangerous illusion of stability. Survival is not safety. The market was supported by historically low interest rates, low volatility, central bank intervention whenever stress appeared. That period is ending. The triggers for the next crisis are already emerging. The first is interest rate volatility. Over $500 trillion in derivatives are tied to rates. Rates are swinging violently for the first time in decades. From 2008 to 2021, near-zero rates allowed banks to take massive positions without worrying about shocks. When the Federal Reserve raised rates in 2022 from 0 to over 5% in just 18 months, stress hit immediately. Banks holding long-duration fixed-rate assets started losing money. Some failures were visible: Silicon Valley Bank, Signature Bank, First Republic. Most losses remain hidden, derivative positions not marked to market. The danger intensifies if the Fed must choose between fighting inflation or preventing recession. High rates create losses for some institutions. Rate cuts create losses for others. Rapid swings overwhelm risk models. Margin calls trigger forced liquidations. Cascading failures follow. Commercial real estate is a second trigger. Over $2 trillion in commercial mortgages need refinancing in the next 24 months. Interest rates are 3 times higher than when these properties were first financed. Many owners will default. Properties cannot support the new debt service. These defaults trigger credit derivatives, specifically credit default swaps tied to commercial mortgage-backed securities. Institutions that sold protection will owe unexpected money. The CMBS market is roughly $600 billion. Default spikes could trigger payouts in tens of billions, not enough to crash the system alone, but enough to weaken regional banks, enough to create cascading failures. European banks are another risk. Credit Suisse collapsed in 2023, absorbed by UBS in a government-forced merger. Deutsche Bank saw credit default swap spikes. Investors questioned its solvency. Both institutions are massive derivative holders. If a major European bank fails, American banks suffer. The interconnections through derivatives are global. A collapse in Frankfurt ripples through New York. Sovereign debt crises represent perhaps the most dangerous trigger. They combine credit risk, currency risk, and interest rate risk. Japan's debt exceeds 260% of GDP. Decades of near-zero rates are ending. Inflation and global pressures make them unsustainable. If Japan raises rates or investors lose confidence in bonds, the yen could collapse. Japanese government bonds could default. The derivative exposure to Japanese debt is enormous. Losses would spread to every major bank worldwide. China faces similar pressures. Local government debt exceeds $13 trillion. Much is hidden off balance sheet. Chinese real estate, roughly 30% of the economy, is collapsing. Developers like Evergrande and Country Garden defaulted on hundreds of billions. Banks and insurance companies that sold credit derivatives will face payouts. American and European institutions are exposed. A Chinese financial crisis directly impacts Western banks. Geopolitical shocks are another layer of risk. A conflict between China and Taiwan could halt semiconductor production. An escalation in Ukraine could create energy shocks, bankrupting European industries. A Middle East conflict could send oil to $200 per barrel. All scenarios create violent market movements. Leverage amplifies losses. Small moves in underlying markets create massive derivative losses. The terrifying reality of the $600 trillion derivatives market. When it fails, there is no bailout large enough. In 2008, governments committed roughly $29 trillion globally to prevent collapse, about 40% of global GDP. It required unprecedented coordination. Every major government, every central bank, every political system accepted measures once unthinkable. It barely worked, and it caused a decade of weakness, exploding government debts, Political upheaval that still echoes today. Today, the derivatives market is 10 times larger, $600 trillion in notional value. If 10% fails, that is $60 trillion in losses, more than double what was needed in 2008, more than half of global GDP. Governments cannot cover that. Debt is already extreme. The US has $36 trillion. Europe is similarly leveraged. Japan is beyond hope. China has massive hidden obligations. Even printing money carries consequences. The Fed's balance sheet grew from $800 billion pre-2008 to $9 trillion at its COVID peak. Money printing fueled the worst inflation in 40 years. Printing another $20 trillion to save derivatives would destroy the dollar. Imported goods would become unaffordable. Real wages would collapse. Social unrest would follow. Political will for another bailout does not exist. In 2008, the public accepted bank rescues. Today, trust in institutions is lower. Inequality has worsened. Populist movements demand the rich pay for their own failures. The too big to fail doctrine is now too big to save. Banks are larger, more leveraged, more interconnected. Derivative books are 10 times bigger. Balance sheets are more complex. Failures anywhere propagate everywhere. Resources to save them are diminished. Government borrowing capacity is limited. Central bank credibility is stretched. Political will is fractured. There is a mathematical problem. Bailing out derivatives is unlike traditional assets. When a bank holds bad mortgages, the government can buy them. Eventually, some value is recovered. Derivatives are contracts, not assets. When one side loses, another wins. Bailing out losers transfers wealth to winners with no productive purpose. Opacity compounds the risk. Even after Lehman, it took months to unwind derivative books. In a systemic crisis, multiple institutions would fail simultaneously. Contracts, bilateral negotiations, and netting agreements would take years to untangle. By the time losses are known, the real economy could already be in depression. The next derivatives crisis is inevitable. It is no longer a question of if, it is only a matter of when. You can't bail out a system you don't understand. The only rational policy would be to let losses fall where they may, to allow insolvent institutions to fail, to confront the consequences directly, not to prop up a system that has become fundamentally unsustainable. That would mean bank failures on a massive scale, pension funds collapsing, widespread unemployment, entire industries shutting down, a severe recession or even a depression lasting years. The economic cost would be catastrophic, but attempting to bail out $600 trillion in derivatives would be far worse. It would bring currency collapse, hyperinflation, all while failing to fix the root problem. Trying to prop up this system would only create more destruction. Right now, we are sitting atop a $600 trillion derivatives market, 10 times larger than the market, that nearly destroyed the global financial system in 2008. It is concentrated in just 4 banks. If any of them fail, the modern financial system could end. Multiple triggers are looming. Interest rate volatility, commercial real estate defaults, European bank failures, Japanese debt crises, Chinese real estate collapses. Each alone is dangerous. Together they could ignite a cascade. The specific trigger almost doesn't matter. The system is so fragile that any significant shock could blow it apart. When one major bank cannot meet its derivative obligations, the cascade begins. Counterparties discover their hedges don't work. Margin calls force more selling. Central clearinghouses suddenly face losses that threaten their solvency. Within hours or days, every major financial institution could be facing losses it cannot absorb. Governments will announce emergency measures. The Federal Reserve will create lending facilities. Central banks will coordinate globally. Politicians will make speeches about protecting the system. None of it will work. The problem is too large. You cannot bail out losses that exceed half of global GDP. You cannot print enough money without destroying the currency. You cannot negotiate enough debt forgiveness to make insolvent banks solvent again. Mathematics simply doesn't work in this scenario. What comes after the derivatives market explodes is unknowable. We have never seen a financial crisis on this scale. The Great Depression was devastating. but it unfolded over years. People had time to adjust. A derivatives cascade would unfold in days or weeks. Much faster than any policy response could keep up. Bank accounts would freeze. Credit cards would stop working. Pension funds would show losses so large that retirement becomes impossible for millions. Supply chains would collapse. Unemployment would spike to levels not seen since the 1930s. The resulting social chaos could be unmanageable. This is not speculation. This is pattern recognition. This is simple mathematics. A $60 trillion derivatives market nearly destroyed the economy in 2008, and that was with massive bailouts. The market today is $600 trillion, 10 times larger, and the capacity to bail it out no longer exists. The triggers are appearing now. Interest rates, real estate, European banks, Japanese debt, Chinese defaults, geopolitical shocks. The cascade is inevitable. The only questions are timing and magnitude. And the answer is likely sooner and larger than almost anyone expects. Because every time a financial weapon of mass destruction has been built, it is eventually detonated. Derivatives are no different.